So I think three things are emerging crystal clear from the last couple of weeks of earnings reports. Number one, inflation is certainly rearing its head. We've in many of these earnings reports, we're having heads of companies talk about the significant inflationary pressures building at all levels. Number two, there is a powerful back half earnings surprise and upward revision story. Look at the magnitude and the sheer number of beats that we're experiencing in this quarter. Consensus is still way too low. Many of the estimates that we're looking at, particularly for the back half of the year, are at 60 and 70% pre-COVID levels. We've moved up the vaccination curve sooner than expected, and the economy is rebounding much more quickly than expected. Now, the third is more of a warning sign that we will have volatility over the next few months. That inflation that's spiking, we saw yesterday with Treasury Secretary Yellen, even though she tried to walk it back, that is a change in posture, the immediacy of the need or the threat to raise rates. And as we know, when we start to raise rates and we push those yields, that provides a headwind to tech and growth, and we might see some retrenchment of some of those traditional pools of money migrate back down the risk curve, which would present some near-term volatility. But yes, the back half earnings surprise, earnings revision story is intact.
But is that, Greg, priced in? I guess that's the question. Completely agree about this economic boom. The question is the economic boom already reflected in the earnings which have been pulled forward?
I don't believe so. So what we saw happen from October or even going back as far as pre-election until now is we saw multiple correction. We saw entire sectors that were trading at multiples that were historic lows. And so the trade from then to now was about making up ground on the multiples. What I'm expecting in the back half, while we're now at historic multiples, is that the earnings is wrong. And as the earnings accelerate, and as the earnings number get adjusted to what they should be, we can keep the multiples where they are and still see performance. So no, I don't believe it's priced in, particularly when you talk about specific stories that have unique tailwinds.
Where is their value, Greg? Leave us with some opportunities.
Absolutely. So if we are going to have a rising rate environment, obviously the financials is opportune. We saw with some of the results already that investment banking and capital markets has been robust, where we saw, for example, at JP Morgan, where it was 50% plus in those divisions, but an improving net interest margin environment lifts all boats to some degree. I'd still favor those large diversified names who have proven that those other businesses are drivers. I'd look at the value shopping sector. Not all of this high savings rate we saw was equally distributed across all socioeconomic groups. So I'd look at that value shopping sector, particularly those who have been investing and will yield from their investments in e-retail, which gained massive share throughout the year. That's what differentiates the Walmarts and Targets of the world from the TJ Maxx's and the Rosses of the world. And even in technology, where we expected there to be a pullback in some of those tailwinds we saw last year, we're actually seeing acceleration in the digital transformation of the economy, etc.
Shepard Smith here. Thanks for watching CNBC on YouTube.